this week on Australian Agenda.
Much money. I can sit here and throw money around just like Ben Bernanke.
There are definitely parts of the housing market that are under stress right now.
Good, hard competition brings out the best in our people.
Greece seems to be off the table as the immediate threat.
We are entering a new world.
The harder we work, the more we should reward ourselves.
Loving it.
I'm here at the CEO cook-off.
That has not collected any real revenue.
It's tarnished. This is not glistening like it should do.
It's about the numbers.
Seen the shares up as much as 15%.
Does this rally still have a way to go?
We'll canvass the best economists in the business.
Commodity prices go up and down. I know that because I watch Sky Business.
3%, a level we haven't seen since the height of the financial crisis.
This is Sky News Business, Australia's business channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities, and I'm Mark Todd from FIIG Securities. And joining me in the studio tonight is Don Stammer, who's a columnist with The Australian. He's also one of the wise old men of the markets. And Tom Murphy, who's the managing partner of the Family Office and Research Management. And for everyone who would know him, it'd be Form. If you have any questions, please give us a call on 1300 30 34 35, and the email is yourmoney@skynews.com.au. Welcome, gentlemen. How are you?
Thank you very much. Well.
The equity markets, they've been quite volatile this week. The last few weeks it's been all one way, and I've been talking about the fact that it's been so centred around the four majors. Don, what's your thoughts on it at the moment?
The share market's only off 4% or so from its peak. It's not been a big shakeout. I'll be revealing later tonight that I'm still bullish shares if you look a year or two ahead, very bullish shares. Right. You get these little setbacks. It's actually been a good market all of this year, not only for the big banks and Telstra, but for smaller companies like FIIG. So it's been a good market, and it's not a bad thing to have a pause.
It has definitely had a pause, and if you were in resources, that was a big pause. So what's your take on the market, the equity market at the moment?
Well, I would echo the sentiments that Don just articulated about where we're going in the next 2 years. We are still fundamentally very good value, and we have to remember that the global economy is just coming off a very deep dip, and we are nowhere near close to the levels of 2007. But I would probably want to remind people first and foremost that the divergence we've had between resources and industrials is an extremely unusual divergence.
Yeah, that's a great point, because Tom has been very kind to bring us a chart, and it's a chart to articulate, and a picture says 1,000 words, doesn't it? So, Jade, if you'd be kind enough to bring up the chart on the resources versus industrials, you can see this thing. It's just quite massive, isn't it, the change?
We just don't see that kind of thing in this market, because this market's been dominated really by two groups, resources and financials. And financials, as Don said, have done exceptionally well because of people chasing yield. But look at resources.
Look at that chart. That's just, I mean, but what is your anticipation on that? On that sort of chart, do you anticipate that quite, I mean, I know Goldman's have come back saying you should start buying resources, buy BHP. That will be the big daddy of them all, and I assume Rio, but when does that gap start to close? Does that start on Monday, or do we still continue to see that for the next...
Well, there's a key word neither of you have mentioned yet, and it's spelled GOLD. A lot of the turmoil, of course, in the last couple of weeks, and particularly the last weeks, come from...
resource companies that on a 1 or 2 year outlook will be good. However, I think a lot of people are sitting to wait them see go lower. What I find encouraging, the management of the big resource companies is now facing up to reality. They're not going to rush out and buy assets. They're looking at returning more cash to shareholders. But you've got to say the mood of the market currently is it's not yet time for shorter-term investors to go back to resources. People want to see something positive from China.
I feel, Tom, that they don't trust the management anymore in the big resource companies. I think whether they're good people or not, I feel the investors feel they've lost a lot of money on the way they use their capital. Would that be a fair way to assume that they're looking at it?
Mark, I think they have. I think investors have become quite disgruntled about M&A activity. constant acquisition flow.
Potash.
And if you look at even the words of the past 2 days, both Rio and BHP have reminded shareholders that costs have to be brought under control. And that's the kind of thing you say at the beginning of a very difficult patch.
But do you buy now, or do you wait to see if they can actually do that, bring those costs in? Is that the sort of thing that you as an investor would like to say, well, I hear the talk, I'd like to see you walk the walk?
We're adding to exposures now, but we are expecting that differential on the graph to narrow. But we are saying to investors that in a global sense, you really have to be with Rio, Vale, or BHP. And 2 of those companies are Australian.
Yeah.
So it's easy to get the exposure right here at home. But I would not bet on that gap continuing to widen. But the reason we highlight those 3 companies is that this type of an environment is going to be very stressful for the small and mid-cap iron ore producers.
Yeah.
Not for the large cap.
Atlas Iron. Yeah. That fell off the cliff.
The good news for the big resource companies is both have replaced their MDs. They go into the tough times with new management absolutely intent on cutting costs and doing a better deal for shareholders. Probably in terms of timing going back to the market, what happens in China will be something people watch. My personal view is people are exaggerating China's short-term problems, but I think that's something the market might focus on for a while and then swing back as markets do.
So let's shift gears just a little bit. Tell me about FORM, Family Office of Research Management. What is that? Because I've got a family office, and it's where I put Darcy, my youngest, when he misbehaves. And he says, get in there and don't come out until you're a better boy. What is FORM?
Well, the term family office in this country is a relatively young term.
Yep.
Overseas, it's more utilized, but it essentially is an office that's set up just to manage the wealth of a very wealthy family. Mm-hmm. The offering that we have is purely an investment offering, but it's for individuals and family groups, whether through super, family trust, or individual names, to manage their money. So it's pure investment advice. And we've also leveraged that advice into not only superannuation but charitable foundations, because many of those same families operate charitable foundations and need similar advice.
We had Chris Cuff on a few weeks ago talking about exactly the same thing, creating that structure where family offices are saying, I need to allocate my wealth to a charitable event, and didn't necessarily have the skill set around, they might have had things they like, but didn't have the skill set around how to do that, how to structure it, how to get the best bang for your buck in terms of getting the money to the people. That seems to be a growth industry in Australia, isn't it?
It is, and we've deliberately differentiated investment advice from financial planning, because we don't do structuring, estate planning, or any of that. Yeah. We just do in the investment side, because Australia needs that specialization, and we are finding very good demand for that service.
So Don, you're a Deutsche Bank alumni, and is that how you've seen an evolution? If what Tom's talking about, family offices are new, is that something you see with all the investment banks looking to try and do through their private banks?
I also see individuals wanting to do it. In fact, it's 11 years since I retired from Deutsche Bank.
It would have changed
the share market.
Yeah, that's right. In fact, I point out these days I'm invited along to things because I'm old. I can now claim to have been alive for 31.8% of Australia's European settlements. So I've been through a few cycles.
But Australians are becoming more philanthropic. A lot of Australians are really looking to give something back. We don't have the tradition of philanthropy that America has. Cynics say it's because America has death duties and we don't. But I just think Australians used to trust governments to look after those who needed support. And we've now got huge amounts of government programs, but a lot of cracks, a lot of needs. And I think Australians in their 50s, 60s and 70s are very serious in joining up for the sorts of things Tom has mentioned and Tom is doing.
The idea that governments, the roles governments play, one of the things that I would say the governments play right now is this QE forever. That's what the government's done in terms of the economies of the world created. The banks had performed poorly, and they turned to the government and said, you better bail us out because we're too big to fail, and they consequently did. I was in Ireland, I was saying last week, I was in Ireland at the time, it was like, children, give me money, give me money. What's the impact of QE forever? What do you think?
The impact of monetary policy that's that accommodative is ultimately going to be price increases. It's going to be inflation. And I think one thing we know from history is that when monetary policy is extremely accommodative, it ultimately leads to asset price inflation. And asset price inflation we are starting to see in equities, but ultimately we'll see it in land as well.
Is that the sort of thing you would think? It's inflationary, and is that? I mean, that's what we all sort of think, don't we?
I think we've got to think of the sequence. The first thing monetary policy, ultra easy monetary policy, does is push up asset prices, and we've been seeing that, and there's more to come. The second thing it does is push up demand for goods and services and be stronger. Then, with the lag, comes the inflationary effects. Now, the inflationary effects are not here and now, and if you look around the world, there's not much fear of inflation. But if you wind the clock forward for about 5 years, you can't have the monetary easing, the monetary creation we've now got, without there being another cycle in inflation. And Mark, I think one of the most important things for Australian investors to think about, not to change their attitude now, not to change their portfolio now, but to think on a 5-year outlook, how do I protect my hard-won saving from the ravages of inflation?
Because, I mean, clearly one of the biggest things that FIIG have at the moment has been the inflation bonds, linked to inflation, whether it be in the form of an annuity or in form of a capital being linked to it. It's incredibly popular because when we go to portfolio constructions seminars, second day, it's inflation, it's the whole day. Every client thinks, I know inflation's coming, I don't know when, I don't know how to manage the timing, what have you got? And you've got a whole array of bonds that link to inflation that they now want to buy. It's a sleeper in the investment world, isn't it?
Well, also, a lot of people retiring now are going to have 30 years of life in front of them, which is wonderful, particularly if they have good health. And if you think, I'm retiring, I've got 30 years to provide for myself, there's surely going to be 2 or 3 cycles in inflation then. It may not be as bad as the inflation we had in the early 50s or the late 70s, but 5 or 6% inflation does terrible things to retirees. So if you think 30 years of retirement, I've got to make this money look after me, inflation-linked bonds, I think, are an essential component of people's portfolios.
The interesting thing with the Japanese coming through with the QE3 and their versions, and they said, right, we are going to print money, we're going to force that yen down. The IMF came out last week saying that the Aussie is probably 10% overvalued. Is there anything you can do about that? Is there anything that the regulators can do about a view that the valued? And what do you think the effect is of this Japanese intervention?
The effect of the Japanese intervention is going to be fairly predictable in the sense that it will debase the yen. But what's far from predictable is, do we see a stock market rise that's faster than the yen fall?
Yeah.
So far we have.
Yeah, right.
I mean, since October, the share market has done much better than what the yen would reflect. The yen has depreciated something, I think it's 28% or something, but the share market is up something like 50.
Yeah, right. We've got a chart that reflects that commentary about where the yen equities are and where the yen is that you were very kind enough to create for us. So do you want to walk us through that chart?
Yes. Since the announcement by Shinzo Abe, now Shinzo Abe, of course, runs a Liberal Democratic Party, and the Liberal Democratic Party took office very late last year, I believe it was October, and the Democrats were forced out. The LDP, up until that point, had been very ineffective in about 20 years of rule. And for most of the last 4 decades, the LDP has actually been in charge. They're a little bit concerned that their past policies are going nowhere, and they need to do something quite out of the ordinary.
That's what this is.
And so they decided to print money, and if you compare the size of the money printing to their GDP, this is far greater than what they're doing in the United States.
Yeah.
And the orange line,
United States on steroids.
This is very much.
And it's also important, Mark, to see the international consequences of what Japan's doing. Japan's doubling its money base in 2 years. We'll see some of that liquidity come to Australia. I'm against another spurt in house prices because I think housing in Australia is still basically unaffordable. But given the amount of money sloshing around the world, partly because of what Japan's doing, I think that'll put some further upward pressure on the median house price in Australia. Not a lot, but perceptible.
Yeah.
It also adds to the hunt for yield that's been the dominant characteristic of investment markets, and as Tom mentioned, and also the demand for assets here, such as shares. So what Japan's doing has big effects in Japan, but it's on a scale that will affect the rest of the world. I couldn't agree more.
Look, we'll have to take a short break, and after that break we'll talk more about what's happening in investment climates. Please give us a call if you want to be part of the show on 1300 30 34 35, and if you have any emails, please email us. The email yourmoney@skynews.com.au. We'll be right back.
Having my own cafe was always the dream. I I know them all by name, but I think of them by their orders. Long Mac, skinny cap, short black, double ristretto. I still remember Dad's face when I told him I quit my job. We can laugh about it now.
Small business, we see you. NAB, we see Australian business.
I'd love a European car, but I've zero interest in paying too much for one. If you're the same, check out Skoda's 0% comparison rate on all new MY12, Yeti, Superb and Octavia models. Get to your Skoda dealer today.
Skoda, simply clever.
TPG presents our Unlimited Bundle. Get unlimited ADSL2 Plus with home phone line rental. Unlimited calls to local and standard national numbers. Unlimited calls to Australian mobile numbers. And unlimited calls to selected international countries. Plus a Wi-Fi modem. All for just $79.99 a month. Yep, $79.99 a month. TPG is a multi-award winner.
tpg.com.au.
Hungry Jack's Stunner Meal isn't just getting tastier, it's getting legendarier. Because now you can get a flame grilled Whopper Jr. served with fries, Coke and a sundae for just $4.95. The burgers are better at Hungry Jack's.
Look, there's a lot of great companies based right here.
We need local businesses.
They drive growth.
In fact, Chevron's doing more than $10 billion worth of business right here.
They create jobs.
We've helped create over 4,000 jobs, like sparkies, welders, pipe fitters.
The economy depends on local businesses.
Our business depends on them.
Welcome back to Your Money, Your Call. My name is Mark Todd from FIIG Securities, and tonight I'm joined by Don Stammer, who's a columnist with The Australian, and Tom Murphy, Managing Partner of the Family Office and Research Management, that is FORM, and they're here to answer any questions you might have. The number is 1300 30 34 35, or you can email us, and the email is yourmoney@skynews.com.au. Before going to the break, we talked a little bit about the QE and the effect of the regulator, and driven by the politicians wanting an easier life. Can I start with you, Don? What's your thoughts on the political environment right now in a macro sense? So I'm thinking more about Europe, North America, and then maybe even Australia at the end. It seems to be conflicted.
It's a tough time to be a political leader. We're just coming out of the worst days of the global financial crisis. There are issues in North Korea, huge problems in Europe making the common currency work. It's not a good time to be a political leader. Probably, for my money, the two most appropriate and apt political leaders in the world are Merkel in Germany and John Key in New Zealand, who's really got on top of a lot of challenges. But basically, being a political leader is tough. I think there's a lot of difference, though, in the issues facing the major countries. China is for the new Politburo to show it's legitimate, to show it can run the Chinese economy. I think, in fact, they'll do a lot to make sure China doesn't slow too long. And when you've got $3.5 trillion of international reserves, you can. The US is actually further along its path of recovery than I think markets are giving it credit for. The US has a better revival sense than Europe has, or we have. In Europe, though, the problems are very deep. I can't see any quick or early solution to what's happening in Europe. I think Europe has to grind its way through many years of repair. Do you want to comment on Australia, or can I leave that for my good friend?
We'll leave that to your good friend, because I do believe that you're right. It is a grind for Europe. I think it is something that they haven't yet embraced. They haven't had the conversation they need to have at a fundamental level with unity around fiscal performance, with banking performance. They just haven't actually decided whether they want to be in the euro. The conversation that the North Americans had in the 1860s resulted in Lincoln winning the battle, and they now would be a unified country. They wouldn't ever think about seceding, except for people being a little bit silly, but they wouldn't really feel it. But you can't say that of Europe, can you? So what's your thoughts on the political environment globally?
Well, globally, just adding to what Don said, I think I would mention that the September election in Germany is a very important event, because the September election is holding Europe back from the next move in terms of growth. And looking at this year, the only major economy in Europe that's going to grow, and it'll probably be 0.4% or so, is Germany. And it's interesting to watch. We are reasonably sure that Chancellor Merkel will win the election with a coalition, though, the way she did the last time. But there's a bit of an attitude in Europe that people like Horst Freiberg from Berlin and people that are actually anti-Euro are quite extreme. They're compared to World War II types in a very unpleasant way. But you have to think that you have to think about sympathy with those Germans who are very angry about peripheral Europe, because whether you agree with them or not, they are not extremists. They are people with a right-wing view, and they are articulating that view very well. And they are angry at Merkel. And it'll be interesting to see the southern parts of Germany, Bavaria, for example, just how little vote she gets from those areas, even though she will win.
And it's the Tip O'Neill view on politics, isn't it? All politics are local, regardless of what Merkel is saying in the grand stage. She's thinking local. She's talking to the locals, even if it's on that stage, isn't it? Because she needs to try and get through September to be able to do what you're talking about. That makes a lot of sense. That's a really good point.
And the social problems in countries like Spain with very high unemployment. Ireland, where you've been recently, has really made some tough decisions, tough adjustments. But unemployment in Spain, the French government being an old-fashioned left-wing 75% tax rate, cutting the age of retirement. France has got a lot of problems. So the social issues in Europe are quite daunting. And don't forget, in Europe, the 17 member countries have a common currency. Those countries are very different. Sure, we have 6 states in Australia that are members of a common currency, the Australian dollar, but we have horizontal fiscal equity. I mean, every Australian talks about horizontal fiscal equity over breakfast, and they don't have anything like that in Europe.
No, and no likelihood to happen in the next few years.
If you don't mind, I can't resist one more comment, because you mentioned the United States. I wasn't going to mention Lincoln, but you did. And Mark, your comment about Lincoln reminds me that when Lincoln came to power, he was brought to power from a small town in Illinois where he represented an obscure party called the Whig Party that nobody knew. And the reason for that was that the Republicans and Democrats couldn't agree on anything in Washington, and they needed an independent. So if there's one lesson for this country, going into the election late this year, it's that voters will get very disgruntled if both parties have no forward-looking policy. And that is the position we're in now. And it's strange for me when I work for wealthy families, most of whom would be coalition voters, how disgruntled those investors are with the opposition party, where you would normally expect them to be welcoming a change. I would welcome a change personally, and I'm not a liberal voter, but in this particular time in space, it is actually so pathetic what's coming out of Canberra that the Whig Party analogy might fit.
That's right. It's true that the populists are crying out, and the investment community in general are crying out for some leadership and some vision. They do want to have that vision. So when Joe Hockey said, I'm thinking a 30 or 40-year fixed income bond curve, issue for 30, 40 years, it was a breath of fresh air. If he actually meant it, that would be incredible. Because having that sort of vision around trying to build for infrastructure, we've had people ring in and say, why can't we have infrastructure to build the roads that we need, and why can't investors do that? It's basically because you haven't got a curve. You can't borrow for 30 years if you don't know what the price would be. It's very hard for corporates to be able to have the vision. We need vision at all fundamental levels in the political sphere. Is there vision in the United States at the moment?
I think there is vision, but I don't think the United States for the next 8 to 10 years will come out of the quandary they're in now, which is one where there's deep division in society between the left and the right. I think they will repeatedly roll budget deficit bills with very close voting in Congress, and they will remain very, very close in terms of the Democrat-Republican split. There is no consensus there. It's quite tragic.
I agree. I think it's very dogma-driven, and I think everything we've talked about just adds to the volatility. So I want to switch another gear and ask, how do you create asset allocation in that environment? When you look at, normally I'm going to buy the United States because there's consistency in performance, or I'm buying BHP, everything is very volatile at the moment. So how do you construct, if I can start with you, Don,
well,
what do you think?
I'm a big believer in people taking asset allocation very seriously. I think over time people make more money out of good asset allocation than they often make from selecting securities within a particular category. So I'm totally in favour of asset allocation. I think everyone's got to have their own asset allocation. It's one of the reasons I'm not very keen on the simplification of superannuation and putting people into default funds. Everyone's got to give thought to their own asset allocation, and that changes as they change in the years. I also believe when people should alter somewhat the asset allocation from one year to the next, and particularly when one asset class is very expensive, as shares were in 2006, 2007, it's not a bad thing to cut that back. Now, bonds are very, very expensive. It's not a bad thing, I think, to cut back the allocation to bonds, or get very good advice on how to manage the yield curve, because we're going to, in the next couple of years, see bond yields move higher. So, you know, get good advice on how to manage the changing shape of the yield curve, or mix bank deposits with bonds, because the bank deposits have lower risk if interest rates are going up. So what I'm saying is asset allocation is important. Everyone's got to work it out according to their own needs, but people shouldn't put it down and set it and just forget about it. There's room to change asset allocations to go against the big swings in markets, so people are not caught out by asset falling out of favour and falling in price.
Now, I'll let you talk about asset allocation, and I'll look for your defence of the bond market. Otherwise, we could be talking for the next hour with me just talking. So how do you feel about the asset allocation question, particularly in this environment? If a client comes in today, I've got X. How are you looking at that asset allocation?
Well, first of all, I wholeheartedly agree that in a few years we're going to have higher interest rates. Yep. And I take that as a given. And it might take a few years to get there, but it's going to. But when I think about the income growth split, which is the first asset allocation decision, I acknowledge that what is called fixed interest does not have to be fixed. Mm-hmm. And your company, for example, specializes in both fixed and variable instruments, and some of the variable rate corporate instruments, which change their interest rate every 3 months depending on where cash is, are very, very useful tools in an environment like this. Yes. And for retail investors, those are, of course, available in the listed hybrid market. That's right.
But I think, and you take that long-term view, rates will go up at some stage, so I should have a portion. I call it the Rumsfeld portfolio. You don't know what you don't know. So I don't know when rates go up, but I do know that rates ultimately go up. I don't know when inflation comes in, but it will come in. And I don't know about fixed, but if I'm getting a good return. And I just want to bring up a chart that we've got in terms of good returns, because we think we're in a very low interest rate environment. So it's hard to work out. Cash rates at 3, and we can talk about the effect of the Japanese pushing rates lower. It's not the RBA will push rates lower, but the Japanese search for yield will drive our rates lower. Look at the performance of Swiss Re Fixed. That's the Tier 1 bond. And that, that performance, the thing I like about that is if I reflect back on your resource equity divergence, to have a portion of that, regardless of where you think interest rates are going, that has just performed steadily, steadily, steadily. I mean, you're familiar with the Swiss Re, bonds. Yes. What's your thoughts on those?
Well, the Swiss Re securities mature in May 2017, I believe. Yep. And they come in both varieties, fixed and variable. That, of course, is the fixed rate vehicle. And the upward slope in that share price of that has been a reflection both of improving credit quality and falling interest rates.
Correct.
That security is very, very likely to repay in full in 2017 and not become a perpetual, which is a possibility. But it's a very high quality instrument and a very good credit. It's an interesting, though, whenever there's a bit of a disaster, a weather disaster or something like that, you often see the reinsurance bonds dip in price just a bit, and it's almost inevitably a buying opportunity.
It is a great buying opportunity because these insurance companies are so good at managing those risks. They've either defrayed them, they're like bookmakers. They've defrayed the risk, they've passed it on to other people, they've got investors that have taken that risk as well, and so they're very good at managing their portfolios.
Mark, talking about asset allocation, we must always remind viewers of the big lessons of the last 6 years, and that is fixed interest, bank deposits and cash are a very, very important counterbalance to shares and the volatility. stability, and also people close to retirement that have a portfolio built up to have enough cash and ultra-safe assets to look after them for, say, the first 3 or 4 years of their retirement makes a lot of sense.
And Stephen Nash, Dr. Stephen Nash from our place, writes about that theme a lot because it takes a lot to convince people to see the benefit of investing long-term in those asset classes that stop the volatility. And clients will come in and say, it's just so stressful. It was so hard to make the return I made this year because of the volatility. I'm constantly looking at the Dow when I get up in the morning. I just want to look at the weather to see if I'm playing golf or tennis or whatever we're going to do. Now, we're about to go for a break, but before we go for a break, we're going to bring back our Speaker's Corner. And, Tom, you're going to be first cab off the rank in the terms of Speaker's Corner. So we'll be setting you up for a 30-second chart. Your chart will start now, and you're on screen number 5. Ready? Here you go. Speaker's Corner for Tom.
I'd just like to make a comment about superannuation and the recent changes we've had from Canberra. I think it was somewhat surprising to the government that the reaction from investors was so severe when their retirement savings were put into question in this way. And while the changes that have been legislated are only going to affect a very few investors, I do think that it is an indication on just how they're thinking. I think we have to be aware of that and watch it, but we have to be proud of our savings base.
It's a metaphor.
A metaphor?
Yep, it represents all the money I save refinancing my home with Eubank.
Refinance with a low-rate U home loan and the rewards are...
Jetstar's Japan sale is on now, so it's the perfect time to book your next adventure. Take off from the Gold Coast to Tokyo for $249, or Sydney via Cairns to Osaka for just $339. And with Jetstar's domestic Japan services also on sale, discovering cities like Okinawa and Sapporo couldn't be easier. There's a one-way, checked baggage not included, selected travel dates in 2013. Sale ends midnight Eastern Standard Time, April 22, unless sold out prior. Conditions apply.
To book, visit jetstar.com.
Hi, I'm Jordan Belfort, author of The Wolf of Wall Street and creator of the Straight Line Sales and Persuasion System. If there's one skill in my life that's allowed me to earn massive sums of money and to teach other people to do the same, it's this ability I have to influence and persuade, to be able to close the deal, essentially. It's basically that one special skill I have that's allowed me to really get what I want in life, no matter what the circumstance. Yet many people think that selling is somehow evil, that it's almost a dirty word. Selling is everything in life. Either you're selling, meaning you're influencing, persuading, or you're failing. Either you're selling someone how your ideas make sense, your concepts make sense, you're selling your kids to make their beds, do their homework. See, it doesn't matter what line of work you're in or whether it's business or personal. You're always trying to convey your thoughts and your concepts in a way that connects with another human being and empowers them, but also gets you what you want in life, too. That's what ethical sales and persuasion is truly all about.
Go to jordanbelfort.com or call 03 9734 7992 to purchase your tickets now.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight on the panel is Don Stammer, who's a columnist with The Australian, and Tom Murphy, Managing Partner of the Family Office and Research Management. If you have any calls, please give us a call on 1300 30 34 35, and the email is yourmoney@skynews.com.au. Feel free to email anything you like, within reason, I guess. I just wanted to go back to, we were talking about some good rates. I believe that whether the RBA wants to lower rates from 3 to 2 3/4, their hand will be forced by market conditions. I believe that the QE search for yield will make Australian fixed income, Australian government bonds very attractive. What's your take on the interest rate environment for the year ahead?
We're of the belief that the interest rate environment the year ahead will bring one interest rate reduction to 2.75.
Yep.
I am in full agreement that the kind of liquidity being printed in Japan will inevitably flow to countries with higher yields than Japan, in other words, Australia.
Yep.
So I think it's inevitable that that force will actually contribute toward rate reductions. And I also think that growth in Australia is sufficiently anemic that it will not hold the Reserve Bank back from that rate reduction.
Making the formal rate reduction to 2 3/4. What would you think, Don?
The Reserve Bank has the right to make another interest rate cut simply because inflation is low.
Yeah.
But the irony is Japan has eased. That's an effective easing of monetary policy in Australia because of the liquidity that will flow here. But because Japan has eased, more people want Australia to ease. The Reserve Bank is worried about the strength of the Australian dollar, and I think on balance we'll see another cut. I do think we're going to see some other interesting changes in interest rates. The banks now seem to me to be competing a little less on term deposits and a lot more on bonus-driven at-call money.
Yep.
And I think we'll see a bit more of that. But there still are some great opportunities in Australia relative to other countries for term deposits. I mean, people mightn't like the term deposit interest rates they were 3 years ago, but boy, compare them with Germany or the United States.
Oh.
People get a good deal here. And the most important thing, I think, is people shop around for the best possible rate without taking on additional risk.
That's right. We can talk about that cash rates in a minute because it is a very interesting subject about how the banks are looking to fund themselves. But we have our first caller. Our first caller is David. David from Sydney, how are you? How can we help you?
Hi there, Mark and team. Look, just a very simple question. Why are you guys jointly and severally accepting what I would call government propaganda that the proposed superannuation changes are only going to impact 16,000 people when all the press I've read from all the experts since then can identify anything up to 200,000 or 300,000 people who will be impacted? It's a very simple question, but I wish this myth of the 16,000 and only those over 2 million would be fixed.
David, it's a very good point. I don't believe that we do fall into the propagandist world and we believe it. I guess, in my view, if I could take that question first, my view is I think both governments, opposition and government, look at the amount of money in the superannuation pool and they just work out how they're going to sell it because they will come for it. It's just too much money. I feel that's the way they look at it. As politicians, they think that's a lot of money. I just have to explain it away. It's Costello's fault or it's somebody else's fault, Keating's fault. They didn't structure it properly. What is your take on it? Because I think we tend to run out of money. We were talking about state governments before.
David, I think your question is premised on the number 16,000. Where does it come from? And it's simply based on an assumption that if portfolio returns were 5%, therefore 16,000 people would be impacted. Now, you and I know that's a big assumption, but it is based on 5%. And had the return been 10%, it would be a very different number. That's where the 2 million came from. And that's all it is. There is no number 2 million that's been legislated at all. It's just an assumption of 5%.
And David, I'd add a couple of comments. I think the biggest mistake the government makes with superannuation are the frequent changes. The second biggest mistake it makes is putting caps on how much people can put into superannuation. So a lot of people 10, 15 years younger than I am will have no opportunity to have enough money in their superannuation when they retire. And the third mistake are some of these numbers the government's offered. Clearly the share market is volatile, and given the volatility in the share market, a lot of people will realise some shares one year, push them into that new tax. The following year their overall portfolio will fall away badly and they won't get a refund for that tax. So I think these changes add to the uncertainty, and there are there's a lot more nastiness in them than, of course, the government spokespeople have admitted.
And I think it's all down to that modelling. They take that modelling data, they're a politician, they might have worked as a lawyer or whatever, and they believe this number, and it's very hard to question back and say, this just doesn't make sense. But they ultimately are told, we need the money, go for the money. The government's push has always been, we have a low interest rate environment, that's a really good thing. We have low employment numbers in terms of, low rate of employment, so unemployment, so that's a very good thing. It's true, historically, we have very low interest rates. How do you invest in low interest rate environments like this? What's a good rate of return? What should people expect? I'll start with you, Don.
People have also got to recognise that they don't want to take too many risks. But, I think Australians can still find some attractive interest rates of 4%. on some term deposits, and in today's circumstances of inflation and risk, that's pretty good. I think there are some corporate bonds that are quality bonds, and they have reasonable rates. I think some of the interest rates on the hybrid products are good, but I always like people to get very good advice on hybrid products because there's such a diversity of them. Some are preference shares dressed up, some are convertible notes type issues, and some of them are unsecured debt. They're very, very different, and there are issues about reset. So I think if people can get 5% dividend yield from a bank, that's good. If people can look at the top quality corporate bonds, that's good. Spreads, of course, have come in the last 18 months.
They have,
so
yeah.
In fact, some of the spreads are as low as they were before the global financial crisis hit. So people have got to be modest, not take too many risks, but particularly if it's the hybrids, make sure they understand what they're investing in.
Is that what you're talking to your clients in the same way? What do you think about this low interest rate environment?
Well, in answer to the first part of your question, Mark, I'd say that a balanced portfolio should look to get a rate of return somewhere between 3.5 and 4.5 above inflation.
Yep.
So if inflation is 2.5, we're talking 6-7%. And that is a reasonable rate of return in this environment.
When you talk to the family offices, so the people who have got a lot of money, and you say that, what's the reaction in general? You know, I don't want to know about specific people, but do they go, oh, but hang on, Telstra's at 8% fully franked, why don't I just put all my money into that? How do they react?
They react with shock because we've been through a period of nearly 25 years now where a rate of return such as that which I just described is extremely low.
Yep.
We've become used to much larger returns. And as you say, dividend yield on a number of stocks is far above what I just said. It's very hard to argue with the point you just made about buying stocks directly.
But how's business? You know, clients are still coming, they're still giving you money, you're still, you know, you've got a nice suit on. I mean, it seems to be you've won the argument.
Business is in part good because we subscribe to the asset allocation principles that Don just described. We think that more than 90% of a return over the long term is going to come from asset allocation.
Yep.
Stock selection is best. We all love to talk about stock selection and one stock versus another, and it's a lot of fun, but it's not where the returns come from.
No, and it makes great chip wrappers, but that's about it.
Yeah.
You know, I do see so many shows that talk about specific stocks that I've never heard of, and the show should be the asset allocation, how you look to prepare a portfolio, and expectations on what sort of return you can get. I think the great question for everyone at the moment, or what part of the volatility question, is China. And you mentioned earlier, Don, about changing government. Some people would say if there's only one government, the one goal of that one government is to make the people happy, otherwise there'll be two governments. What's your thoughts on China at the moment?
I think the market this week, Mark, has exaggerated the problems China's now facing. I mean, earlier this week, China came out with a growth figure of 7.7%.
Yes.
In 12 months to December, it was 7.9%. And China comes out with its GDP numbers 15 days after the end of a quarter. And that's in a country with 1.4 billion people.
Yeah.
So those numbers have got political gloss. They're also very much approximations. But China has the ability to ensure that the economy grows at a reasonable rate. It's a command economy. And to be fair to China, it's starting to do the rebalancing of its economy away from exports and heavy capital spending towards consumption fairly well. China's problems are corruption, bad banks, bureaucracy. China has problems, but I think China will deliver reasonable growth. It'll have a cycle, but China will deliver reasonable growth. And I think a couple of years ago people were too optimistic about China. Last year they feared a deep recession, which didn't occur, a hard landing. And just at present people are saying the authorities in China can't keep the economy going along at a reasonable rate, and I think that's incorrect. China will achieve moderate growth. The markets currently are too pessimistic, but China has those horrible problems, as I say, corruption, bureaucracy and banking debts.
Where are you in China? What's your thoughts?
The new Central Committee's only been in power since the fourth quarter of last year, and they officially took power in March of this year. So it's been a very short time frame, but a couple of the numbers that came out the other day were really interesting. Apart from the 7.7 growth, which disappointed people a bit, there was an increase in electric power utilization of only 4%, which says industrial production has slowed.
Right.
And the other one was the double-digit drop in retail sales. And that was because the new government said we don't like government officials giving big gifts, and people in government were afraid to shop for expensive gifts.
Let's look at the chart you brought showing how the China story versus the US story. We've got it on screen now.
Yeah.
And so let's walk the viewers through what you're seeing here. The blue line is the developed countries, and that's the performance they've done. And everyone would be shocked to know, I'd imagine, unless you're following China, the performance of the Chinese economy, the Chinese stock market.
And in a nutshell, the green line is 50% North America, about 30% Europe, and about 10% Japan, and then the rest.
Right.
And the other line is the emerging markets, and that does not include frontier markets like Africa, but it includes 60% Asian markets and 40% Latin American, Eastern Europe. So it's the developing markets. And we've had a prolonged period of chronic underperformance by the emerging markets, while we've had this boom in the United States in particular, which has led the green line higher. But that is a very surprising graph in the sense that economic growth is coming from the orange line, not the green line.
Yeah, and I think that's right. Isn't it interesting how the economic growth is from the emerging markets, but their stock market isn't reflecting that? And that's an unusual aspect.
China has almost a total disconnect between its economy and its share market. What drives the Chinese share market into boom periods is easy credit. And of course, as we all know, China's had fairly tight credit for a while because of the excesses in the property market.
Yeah.
Once China's got rid of those speculative excesses in the property market, and that's not yet, and starts easing up on credit, that's when you'll see a substantial upleg, I believe, in Chinese shares. It's not yet, but it's something worth keeping a very close watch.
Now, Don, while you've got the floor, we're going to bring in the Speaker's Corner for you, so your time will be starting in the next few seconds, but you have 30 seconds to tell us. Let's talk about whatever you might find interesting. Don, over to you.
I hear a lot of people saying that when they look at the big countries, monetary policy is ineffective. I believe very strongly that monetary policy is effective, but after a crunch it operates with very long lags. And I think there's more potency in the monetary easing than people have recognised. I think you will see a cyclical upswing. So I'm a big believer the next few years will be in a bull market in shares and a bear market in bonds.
Stop it. I'm glad you left it there.
Jetstar's Japan sale is on now, so it's the perfect time to book your next adventure. Take off from the Gold Coast to Tokyo for $249, or Sydney via Cairns to Osaka for just $339. And with Jetstar's domestic Japan services also on sale, discovering cities like Okinawa and Sapporo couldn't be easier. There's a one-way, checked baggage not included, selected travel dates in 2013. Sale ends midnight Eastern Standard Time, April 22, unless sold out prior. Conditions apply.
To book, visit jetstar.com.
This is Campylobacter jejuni, a tummy-churning, far-from-home, trip-spoiling bug. But what if you don't know the local word for bug? We'll help card members find a doctor who speaks their language, in the middle of the night or the middle of nowhere. With 12,732 medical cases sorted worldwide last year, it's all part of the Just What the Doctor Ordered service we deliver daily. American Express. Realise the potential.
Arthritis can have more than one symptom, like joint pain, stiffness and a lack of mobility. So I recommend a product with more than one active. Osteocryl from Nature's Way, with 3 big hitters for arthritis relief. Osteocryl combines glucosamine for joint repair, fish oil for omega-3 and krill oil for joint pain and swelling. All 3 ingredients in powerful Osteocryl. Help relieve your arthritis and keep moving with Osteocryl. It's Nature's Way.
Welcome back to Your Money, Your Call. It's bonds and equities. I'm Mark Todd from FIIG Securities, and joining me on the panel tonight is Don Stammer, a columnist with The Australian, and Tom Murphy, the Managing Partner at the Family Office and Research Management. We're going to go straight to an email. It's Lee from Torquay. She writes, Mark, I'm very impressed with what you were saying about inflation-based bonds. Please explain in detail how they work and how a SMSF would buy them. I'm glad you're very pleased, Lee. We do a lot of inflation-linked bonds. There's two types to look at. The capital index bond, which, Lee, if you put $100 down and you buy the bond, your $100, the capital, expands at the rate of inflation. So $100 down, 2.5%, $1,250, $105, that money expands. The other inflation-linked bonds are the annuities, where you have an income stream and that is targeted to the inflation. The types of issues that you would have in that bond would be the one we were talking before we went off air. Sydney Airport issue an inflation-linked bond. They issued the 2020s and the 2030s, which would seem like a long period of time, but in truth, the idea around inflation is not trying to pick it, it's trying to cover for the duration of it. There are others. The Australian National University has an inflation-linked annuity, and that will go at, that's a AA, that's a very high-rated asset, so that'll perform quite well in terms of the credit worthiness. So there's an array of products. The place you can buy them, clearly you can buy them at FIIG, but I think you can find them, there'll be other organisations that start to issue. We'll see consistency in companies looking to issue inflation-linked bonds, so you could start with us at FIIG, but I'm sure you'll be able to find a few others. You both like them. We
I'd
both
also
spoke
mention
about
there's some government-issued inflation-linked bonds too.
Yeah.
People want lower yields than the private sector offers, but of course with the government guarantee. So I just think I'm not smart enough to know what inflation will be next year or in 5 years' time, but I'm smart enough to know that if inflation picks up cyclically, and there's got to be a fair chance it will, I want protection against it on my hard-won savings. Particularly, I'm planning to live for about another 30 years.
That's right. I mean, it's such an easy product to understand once you've started to do the work, I think. If the capital grows at inflation and I get 3% on that $100, and then as that's growing, if you look at the price in the 2020s, the inflation effect for it, it's now at $125. You can see inflation in its actions. It's quite an interesting, experience.
The only other thing I'd say to Lee is that if she were buying one inflation-linked bond for her portfolio, buy the Commonwealth government stock because you have no credit risk. But if you want a bit of a better yield, and this would be my choice, I would buy infrastructure-related infrastructure bonds like the Sydney Airports one, but I'd probably buy 4 different ones equally because you do actually have credit risk on the underlying corporate entity, and you don't want to have all your portfolio in one.
Good point. The trends in self-managed super funds, what do you think might be happening in terms of the investments that they're looking at now? If we've got Lee looking at inflation-linked bonds, which would be a fantastic thing for a portfolio, what other trends are you seeing at the moment?
One thing I'd say to you, Mark, is that if concern about government policy continues, people are going to start doing some really strange things like borrow on property within super to keep the taxable income down. Things like that are very detrimental to our savings base in the long term.
Yep.
But we could start to see craziness like that erupting if there's uncertainty about the government's savings policy. So we've got to get to a point very quickly where we have bipartisan support for wherever we're going, so there's no question about the safety of super. We cannot go back to 2 months ago ever again.
Are you of the same view?
Very much so. I'd just add that when Mr Costello was Treasurer, he did authorise self-managed superannuation funds to do borrowing of a special kind. It's got to be non-recourse to the self-managed super fund, but a lot of people are taking up that opportunity now. They're borrowing non-recourse and buying investment property. And I can see that there's merit in that for some people, but you're starting to get these property spruikers coming in very heavily, really pushing a lot of pressure on people to use that, often with a particular house or investment property in mind. And I just say to people, have a cold shower, take advice, be very, very aware of pressurised sales programs programs, because I think we're going to see a number of self-managed superannuation funds take on too much debt for a property investment. They'll end up with a particular asset that may be illiquid. They'll want to draw down on their asset in retirement, but they will have one asset not producing enough income. Look, there are a lot to worry about these kinds of opportunities for people to borrow, particularly when high-pressure salespeople get hold of them, so be very careful.
Yeah, I couldn't agree more. I think we were talking before we came on air about Chris Cuff. He writes the cufflinks. I really like it. I didn't get today's because I was driving around like a maniac, but he has a very nice independent view on a lot of these things. It's very interesting how he wants that bipartisan support. But they were talking today, and you were saying before we came on, that the idea that these things, the spruiking of property, borrow money, this is a tax, one of the things we're trying to do with the show is educate people. It's interesting how that's not everyone's goal. Not everyone wants to educate. A lot of people just want to sell property or make a clip on the borrowing. And that's hard for people to... Self-managed super funds are growing at 500,000. I think they're 30,000 every month. Yeah. It's interesting to... How do you think the government can get to the education piece better? And I know it's completely out of left field, so...
I don't know if it's the government's role to educate us on super. I believe it's the investor's role to do that. I think it's the government's role to give us a stable and certain framework from which to invest in super. We have to realize that we've got a superannuation savings base of $1.5 trillion, and that's something we should be extremely proud of. It's almost in the Singapore League, and very few Western nations have a savings base like that. But we can't continue to let the savings base simply be vulnerable to the financial service industry for its profitability. It has to go much deeper than that.
Don, what did you think about the idea around the government's proposal of custodians for the superannuation industry? What were your thoughts on that?
It sounds a good idea. I want to see who they appoint. Because there's a lot of divisions within the Australian savings industry, Australian superannuation industry. Sometimes those divisions are plain silly. I think Australia's disadvantaged by the rival advertising between industry funds and retail funds. I just don't think it's in anyone's long-term interest to have some of the silly things both sides are saying to each other. But the custodians is a very good idea, provided they staff it with the absolutely outstanding, independently minded people. There are some around, but governments too often appoint friends. Governments of both political persuasions appoint friends, not experts.
And I think you're right. The key to that is the independence. If you're a custodian, I'd like to see that they were paid and that they couldn't take a cheque from anyone else. So they couldn't work in the industry. You'd have to retire from the industry in the role you played in it. The idea you hear about Goldman's. They staff the Treasury in the United States. They have all these different roles because they leave. And they say there's an embedded, dissatisfaction around it's all the Goldman's people. But I think if you move a Goldman's guy or whoever and he says, I've given up my job and I'm going to work for the government, I think that's a really good thing to be able to encourage people to do, don't you?
Yes, as long as they source the people from different walks of life.
Can't all be Goldman's. we don't want to do that. The underlying view, though, is governments need to sort of get out of it, don't they? They need to be able to say, this is what the plan is for the next 10 years, we're out of this. You've got $1.4 trillion. I don't know how you got it, but you did it.
And the optimist says in me that the best vehicle for personal savings is superannuation, because whatever government comes in the long term, we can't attack superannuation because it is going to pay for our retirement and we're going to live longer.
And we want to have a quality retirement. Longevity is another issue. We'll talk about that next week. We've got Roger Montgomery, and that's going to be the wrap for tonight. So I'd like to thank Don Stammer for coming on the show. As you know, he's the wise man of the markets, and he's a columnist with The Australian. We've got Tom Murphy, and I'd like to thank him. He's the managing partner for the Family Office and Research Management. And to all our viewers, thank you for the calls and the emails that came through. I'm Mark Todd from FIIG Securities, and have a great Friday night. Enjoy your weekend.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.